Imagine a company as a multi-talented artist juggling several skills: singing, dancing, acting, and painting. Now, each talent is unique and appeals to different audiences. But managing all these together, it can get a bit overwhelming and might dilute the artist's overall appeal. Now, a company works in a similar way. When a company has diverse businesses under one roof, it might face challenges in maximizing the potential of each unit. Now, managing these different segments can be complex, and sometimes the overall value gets diluted. So, what's the solution? A demerger. Now, in a demerger, a company splits its different business units into separate entities. In 2023, Reliance Industry demerged its financial services arm, creating Jio Financial Services as a separate entity. Now, the financial service business had immense growth potential but was overshadowed by Reliance core businesses like oil and gas, telecom, and retail. Now, by creating Jio Financial Services, Reliance could unlock the value of its financial service segment, enabling Jio Financial Services to focus entirely on fintech and lending. Now, post-demerger of a company, each of these new entities can operate independently, focus on its core strength, align better with its specific market and audience. Also, operations and management structures become simpler, and risk associated with managing unrelated businesses are reduced. And also, the ultimate goal of a demerger is to unlock value for shareholders. And when a company demerges, magic happens on the valuation front. The separated businesses now standing on their own can often command a higher valuation than when bundled together, given the growth potential. Now, the core business, which is the original company, might also experience a surge in value because it can now focus entirely on its primary area of expertise. Now that we've understood what a demerger is, let's talk about some demergers that are expected to happen in 2025. Now, our first demerger is the much discussed ITC demerger, something that's been making waves in the market lately. Now, what's this demerger all about and why is ITC doing it? Now, ITC, as you know, is a giant with multiple businesses: cigarettes, FMCG, paperboards, and of course, hotels. Out of all of these, the hotel business is the least profitable. Why? Because running hotels takes a ton of money and the returns are slow. Now, let me give you an example. ITC hotels use up 20% of the company's capital, but when you look at their contribution to profits, it's only around 2%. So the idea here is simple: separate the hotel business into its own company called ITC Hotels. Now, through this, ITC Limited gets to focus entirely on its core strengths, businesses that make more money with less capital. Now, the cigarette business, for example, dominates the market and generates massive profits. Then there's FMCG, where ITC has created strong brands like Ashirwad and Sunfeast. Now, second, ITC Hotels can now operate as a standalone company. They'll have the flexibility to focus solely on the hospitality sector, making their own decisions and grow faster. Now, let's look at some numbers. ITC Hotels saw a strong comeback in the past 3 fiscal years after COVID. Between fiscal year 22 to fiscal year 24, ITC Hotels has grown at a CAGR of 51.6%, while EBITDA has grown more than 200%. Now, it is also readying for the next phase of growth where favorable macros and demography, government infra, and tourism push will continue to drive the hospitality industry. Now, ITC Hotels will be starting with about 1,500 crore rupees in cash to kickstart growth plans. They also have zero debt, which means no loan payments hanging over their heads. And they're also going satellite, focusing more on managing properties rather than owning them outright. Lastly, they're also aiming to increase their management fees by about 2.5 times by fiscal year 30. Now, as a shareholder, here's what it means for you. Now, the demerger was announced in July 2023. The board of directors approved it in August 2023. It also got the necessary approvals from CCI and NCLT. Now, usually it takes about 12 to 15 months for a demerger to come into effect. Now, the effective date of the demerger was on January 1st, 2025. This is when the demerger officially came into effect. The record date was January 6, 2025, which is the cutoff date. If you own ITC shares on this day, you're eligible to receive shares of the newly formed ITC Hotels. Now, if you had held ITC shares, you'll get 1 share of ITC Hotels for every 10 shares of ITC Limited. For example, if you had 50 shares of ITC Limited, you will now get 5 shares of ITC Hotels in addition to still holding your ITC shares. Now, basically, you're now getting shares in 2 companies. One is ITC Limited, strong in cigarettes, FMCG, paperboards. The other is ITC Hotels, which is a pure play hospitality business. Now, ITC will retain 40% ownership in the new hotel company, while the remaining 60% will go to shareholders like you and me. In summary, ITC Limited gets leaner and more focused on its core businesses. ITC Hotels gets the freedom to grow as an independent company. And as shareholders, we get direct exposure to both worlds: a diversified company in ITC and a focused hotel business. Now let's talk about the demerger of Aditya Birla Fashion and Retail Limited, or ABFRL. Now ABFRL, as you know, is part of the Aditya Birla Group, one of India's leading conglomerates. It has a bouquet of popular fashion brands in retail formats from pantaloons to Ralph Lauren. Now, the Aditya Birla Fashion and Retail had approved the demerger of Madura Fashion and Lifestyle Business into a separate listed entity named ABLBL at its board meeting in April. Now, again, this is aimed at creating two focused entities, each with its unique strengths, goals, and growth strategies. Now, post demerger, here's what the picture looks like. Madura Fashion Limited, consisting of 4 lifestyle brands, that is Louis Philippe, Van Heusen, Alan Solly, and Peter England, along with casual wear brands, that is American Eagle and Forever 21, and sportswear brand like Reebok, will be demerged into a separate listed entity called Aditya Birla Lifestyle Brands Limited, or ABLBL. Now, this contributes about 42.4% of the company's total revenues and about 61% to the company's EBITDA. Now, Aditya Birla Fashion and Retail Limited will have the remaining businesses, which will include affordable fashion under pantaloons and Style Up. It will also include ethnic wear portfolio, luxury and premium platforms like Collective, galleries, and select luxury labels and digital first brands. Now, the logic behind the demerger is to unlock value and fuel growth. Right now, ABFRL is managing a massive portfolio of brands across lifestyle, value, ethnic, luxury, digital-first categories. Now, by creating two distinct companies, each can focus on its strengths, grow independently, and attract targeted investments. Now, ABLBL will focus on legacy premium brands and high-growth areas. Meanwhile, ABFRL will zero in on value, ethnic, luxury, and digital-first fashion segments, which have larger addressable markets and tremendous potential. Now, ABFRL may also attract higher growth multiples given its focus on underpenetrated segments like ethnic wear, digital-first brands, alongside luxury platforms that are still scaling in the country. In terms of financials, the business's assets and liabilities will be split. Out of the overall borrowing estimated at around 3,000 crore as of March 31, 2024, 1,000 crore will move to ABLBL and the rest will remain with ABFRL. Now, within 12 months post-demerger, ABFRL plans to raise around 2,500 crore rupees in equity capital to strengthen its balance sheet and fund the growth of its businesses. Now, how will this impact shareholders? Now, for every share of ABFRL you currently hold, you'll get 1 share of ABLBL in addition to your existing ABFRL shareholding. Now, other details such as the effective date and record date for this demerger has not been announced yet. Now, with this demerger, Aditya Birla Group is setting the stage for each entity to grow at its own pace and tap into its respective markets. On one side, you have the legacy, steady performers. On the other, you've got high growth, high potential segments ready to scale. Now let's talk about Tata Motors. Now, Tata Motors is not just a leading automobile manufacturer, but also a key part of the Tata Group, one of India's most respected conglomerates. Now, Tata Motors has a strong hold in India, where it's the market leader in commercial vehicles and among the top 3 in the passenger vehicle space. And their product lineup is also quite diverse. They've got commercial vehicles, which includes trucks, passenger vehicles catering to everyday customers, luxury vehicles under the Jaguar Land Rover brand, which is their premium offering, and of course, electric vehicles. Now, here's a quick breakdown of their segment revenues. 70% of it comes from JLR, which is their cash cow contributing the lion's share. 17% is from commercial vehicles, and about 11.52% comes from passenger vehicles, and the rest, about 1.5%, is from other operations like IT services, insurance broking, and vehicle financing. Now let's dive into the big announcement, the demerger. Tata Motors has decided to split its operations into 2 separate listed entities. Tata Motors Commercial Vehicles Limited for the CV business and Tata Motors Passenger Vehicles Limited, which includes PVs, EVs, and JLR. But why this demerger? Well, the main objective is again value unlocking. By separating these businesses, each one gets the freedom to pursue its growth plans more effectively. Plus, the company also mentioned that while there's limited overlap between the CV and PV businesses, there are some great synergy opportunities between their PV, EV, and JLR segments. So this move is all about making the most of these synergies. Now let's break it down further. How much do the PV and the CV segments contribute? Now, PVs, including JLR, account for a whopping 81% of the revenues. Tata Motors has captured around 13.3% market share in India's PV market. And EBITDA margins for this segment also stands at 6.2%, and for JLR, it is 11.7%. And also, JLR alone contributes 64% of the company's total profits. On top of that, Tata Motors has a 65% market share in EVs. Now, coming to commercial vehicles. CVs contribute about 17% of the company's revenues. Tata Motors dominates the CV market with a 38% market share, and EBITDA margins for this segment are also at 10.8%. Now, what does this mean for investors? Now, firstly, this demerger isn't exactly shocking. Tata Motors has been gearing up for this since 2021, with each division, PVs, JLR, and CVs operating independently under its own CEO and growth strategy. The Tata company had said in a regulatory filing in August 2024 that the demerger of its businesses into two separate listed entities is expected to be concluded in the next 12 to 15 months. Now, the share entitlement ratio is 1:1. That means if you're a shareholder of Tata Motors, you'll get the same number of shares in both the new listed entities. Now, post demerger, the CV entity might see a low market cap and could even drop out of benchmark indices like Nifty and Sensex. On the flip side, the PV business with its strong growth prospects is expected to remain part of these indices. So what's the takeaway here? So this move is all about giving each business the spotlight it deserves. It allows the PV and CV divisions to showcase their true potential, especially when listed separately. Now, all eyes will be on the listing of these new entities and how they shape up in the market. Now, one thing is for sure, this is a big strategic step forward for Tata Motors. Now, next up is Siemens Energy. Siemens is a renowned name in the engineering and metal sectors. It's one of the oldest and largest players in India. Now, known for its expertise in power, automation, digitalization, Siemens serves industries like energy, transportation, healthcare, etc. Now, the company has decided to demerge its energy business into a completely separate listed entity called Siemens Energy India Limited. Again, there's a move aimed at unlocking value for shareholders and allowing both businesses to focus better on their respective markets. Now, let me explain this step by step. Now, basically, Siemens Energy India is currently a wholly owned subsidiary of Siemens Limited. After the demerger, it will become a completely independent company that will also be listed on the BSE and NSE. Now, as a shareholder, here's what you need to know. For every one share of Siemens Limited you own, you'll get one share of Siemens Energy India Limited. So, if you're already holding Siemens shares, you'll end up with shares in both companies. Now, let's talk about the objective of this merger. Now, the energy business and the industrial business have completely different needs when it comes to market strategies and capital allocation. Now, splitting them up means both can focus entirely on their own goals. Now, Siemens Limited will stick to its strengths. It will focus on technology-driven sectors like industry, infrastructure, and mobility. Now, these are the areas where Siemens has traditionally been a leader, and it will continue to drive innovation there. Now, Siemens Energy India Limited will take charge of the entire energy business. It's going to focus on the energy value chain, everything from power and heat generation to transmission and storage. Plus, they're diving deep into renewable energy technologies like hybrid power plants and hydrogen solutions. Now, let's talk numbers. The energy business contributes about 30% of Siemens Limited's total revenues. On the profitability front, the energy business boasts an EBITDA margin of 15.7% for fiscal 24, higher than Siemens Limited 12.8% EBITDA margin, which excludes the energy business. Now, the profitability edge highlights the value the energy business can bring as an independent entity. And the management is also confident that this demerger will enable more efficient decision making, particularly around capital allocation. So, what's next? Now, the entire process, including approvals and the listing of Siemens Energy India, should wrap up by 2025. Now, from that point, Siemens Energy India will start trading as a separate company in the stock market. So these are some major demergers expected to happen in 2025. Now that we have spoken about the major demergers, let's also talk about the several key aspects that investors need to keep an eye on when it comes to demergers. Now, first is a share entitlement ratio. This tells you how the parent company shares will be split into the new entities, and this ratio directly impacts your holding in the newly created entities. For example, in Tata Motors' case, the 1:1 ratio means investors will get an equal number of shares in both the commercial vehicle and the passenger vehicle business. Now, second is the record date. This is the date on which shareholders must own the parent company shares to be eligible for shares in the demerged entity. Now, third and most important aspect is to understand why the company is opting for a demerger. Is it to unlock value for shareholders, simplify operations, or focus on distinct business verticals, or to reduce risk of unrelated businesses under one roof? Now, post-demerger, the valuation of each entity will often differ based on its own growth potential and profitability. Investors should evaluate whether the separated businesses have the potential to command higher valuations individually than as part of the parent company. Now, each entity will now operate independently, so it's essential to analyze their business strategies. Look for how they plan to allocate resources, for how they focus on innovation or expansion or synergies, and the leadership and management approach. Now, post-demerger, the financial statements of each entity will reflect their true standalone performance. Focus on revenue and profit generation, debt levels. Sometimes one entity may take on more debt from the parent company, and cash flow sustainability. Next, assess how each new entity is positioned in its respective sector. Look at macroeconomic trends, competitive landscape, emerging opportunities like, say, EV growth or infrastructure development in Tata Motors' case. After the demerger, smaller entities might lose their place in benchmark indices like Nifty or Sensex. In Tata Motors' case, the CV business might drop out of the indices due to its relatively smaller market cap. So this was our attempt to teach you about demergers. Having said that, this is me, Merlin Susanna, signing off. Take care and stay invested.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.